Very good afternoon. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. The markets are doing okay, hugging the just a flat line. But there was a very big short covering rally and some buying also was seen on the cash side yesterday. So even if we maintain the gains made yesterday, it will be taken as a positive because we are at the higher end of the range we've seen in the last couple of weeks. 16, 17,400 to 18,000 is the kind of range Nifty has really worked in between. Similarly, for Bank Nifty, 41,800, 41,700 is the kind of a hurdle and resistance it needs to take out to really climb on further. But earnings season is winding up. So much to talk about. Viral Berawala of Buoyant Capital is joining us on the show now. Viral, let's start with your observation on the quality of earnings which you posted this quarter. One sense is that in general, the quality of earnings were weak. Margins were hit, profit growth was anemic, and same was the volume and top line as well. Some price hike led top line growth was seen. Do you see this as a temporary phenomena, 1 or 2 quarters, or do you see meaningful cut in the earnings growth trajectory of corporate India?
There are like four large sectors, right? Financials, IT, FMCG, and oil and gas. So what we are referring to, especially on the FMCG or the entire consumption basket, that was the trend we saw. Volume growth was practically zero, and margins were hit because of the inventory. Companies were carrying a lot of high cost inventory, which they had bought in Q1 and Q2 of the financial, which has not run down. So from this quarter's numbers, maybe we'll see a little bit bump up in margins, but clearly consumption and especially discretionary consumption is under pressure. You talk to dealers, a lot of this sort of events have happened, and there we have seen companies talking down on the growth expectations on the at least the volume side. So that seems to be sticky. Margins from a low base will likely come up.
Viral, how are you positioning your portfolio in this kind of a market? Are you more defensively positioned, or are you taking advantage of the weakness some of the stocks are witnessing because of earning cuts, etc.? How are you approaching this market?
So it's a sort of two-phase market, right? The largest component of the market, which is financials, is doing very well. So that's almost 35 to 40%, including insurance, that's almost 40% of the market. That is doing well and likely to do well. The credit cycles in India generally have tended to last long. It's not that you get 2 or 3 good quarters and suddenly the credit cycle reverses. So maybe we are in the middle of this good credit cycle, and maybe after a couple of quarters, maybe take a relook and look at financials. And within financials, we are actually looking at sub-sectors which have not done well. So take MFIs, right? MFIs have been a laggard since COVID and they've continued, but now we are seeing green shoots there and valuations are not as expensive. Some of the larger banks have sort of run up, and I don't see much of valuations gain there. The only gains that we should going forward see are the growth gains. So within financials, that might be one area. Secondly, a bit of a higher risk reward investment might be in life insurance. So because right now there are a lot of unknowns and markets don't like unknowns, and that's why the stocks are being priced at the rates at which they are. The big unknown in life insurance stocks is that how many people will go to the new tax regime, and once they go to the new tax regime, how will they look at insurance? Is insurance just to save taxes, or people are actually looking at protection and savings too? My view is that it's the second one. While it gets pushed as a tax saving product, but eventually people do realize that it's a protection thing. And what will also likely happen in life insurance is that people will move to more term plans, which are much more margin accretive. So while the new business growth might not be as high, at least definitely for FY24, but we will see margin accretion continue in life insurance. So within financials, this is how we are positioned. We really don't have too much of consumption. As I said, we see discretionary consumption under pressure. And same actually extends even to auto. Not have auto OEMs, but be more towards ancillaries, be more towards exporters. That's where we are. IT, we continue to be underweight. We know that the stocks have underperformed for a very long period of time, almost 13 months now. But in IT, again, cycles tend to be longer. We see IT going to single-digit growth with margins under pressure. Rupee went from 75 to 82 over the last 1 year, and margins are still down. So clearly, IT we think will take some time to recover it. again becomes a single digit sort of growth sector. And finally, a lot of small caps might be interesting. Small caps, if we were to look at advanced decline of the whole market over last 13 odd months, it is probably 1 is to 3 or something. So especially there are a lot of small caps which offer value. This might be time to start nibbling at small caps with the risk of a temporary underperformance there.
That's a very valid point you've said. I'm curious. I mean, I must congratulate you on your call on some of the insurance companies which are hugely underperforming and they've done pretty well. Uh, I want to understand how's your portfolio looking right now in terms of earnings growth. I mean, for this quarter ending, what are the kind of earnings growth your portfolio got? And if you stress test your estimates for the next 1 year on the hypothesis we've been talking about, what kind of worst case scenario earnings growth your portfolio is likely to see over the next 12 months?
Sure. So the portfolio did well because we were in a few chemical companies which did well, and of course, large ways to financial. So portfolio probably grew a little bit better than the market. But that's the interesting point, right? Market is probably looking at 1,000 rupees Nifty EPS for FY24. Used to be 1,030, and now, give or take a bit, we are at around 1,000 rupees the Nifty estimate for FY24. That would be again a 13 or 14% rise over FY23. We find that extremely challenging. If your larger profit earning sectors are not going to deliver, and at some point this great credit cycle also starts ebbing, then you will unlikely that we'll see this 14% growth happen. Maybe we will again be back to 9-10% growth on the Nifty. A portfolio shouldn't be too dissimilar to that.
Viral, what about the actual earnings which we have reported, which are likely to report for 23? On that, how are the valuation looking? Forget about the estimate because that is susceptible to changes. But on actual earnings, how is the valuation looking right now?
Yeah, so I don't have a 12-month number, but we can easily take FY23 number. That should be 870 to 880 rupees on Nifty. So you are at little over 20 times on historical earnings, and that is probably 5 to not even 5, 8 to 10% higher than the average. So we are not exactly cheap or inexpensive, whereas most of the emerging markets are much lower. Most of them are at least one standard deviation lower than their mean. So while India has underperformed over the last 4 odd months, but despite the underperformance, our premium to what is our peer set continues to be high. We are at 70% odd premium to MSCI emerging markets. We all know that our average premium tends to be between 45 odd percent. So we are still priced to perfection in a way.
Hmm. Right. Fair point. In fact, if you look at some of the commentary coming from players like Kajaria, Pidilite, Asian Paint, no volume growth, all these footwear companies, barely any volume growth. There is clearly sense that slowdown is now seeping through. And also the rate hikes which have been done in the last couple of quarters, they will start showing in with a lag in the next 1 or 2 quarters. What are your thoughts if the problem is compounded by a weak start of monsoon? Because early trends seem to be suggesting that after 4 years of La Nina, which ensured adequate monsoon, this time we may face El Nino, which is some kind of a weakish start to the monsoon at least. Is that a risk on the table?
That's definitely a risk. So, hindsight is 2020, right? All of us now realize that because of the two sort of festive seasons washed away due to COVID, there was a lot of pent-up demand that happened on discretionary consumption as well as on other sectors like hospitality or auto, and that has gone out. Maybe there was in fact a lot of overbuying or revenge spending that happened. So on one side we are facing that rural has been weak. You mentioned some of the companies like Pidilite, but we also saw in the Unilever's numbers, right, which I consider the barometer of how rural India is performing. So rural will likely be under pressure, and urban really can't make up for it. It's easy to say that urban is probably two-thirds of spending, but what happens is that there is a fall-on impact, and if especially on consumption stocks, you will see much more impact because of that. And plus, you will see other impact on agriculture implements or yeah, to an extent even on fertilizers, etc. So a part of that impact will happen. And see, we have been lucky. We got 4 years of a positive monsoon cycle. Generally, it has been 2 or 3 years. So we've been lucky for last 4 years. It was the probability of having a bad sort of monsoon cycle is reasonably high for 2020.
Right. All right, Viral. Thanks very much for joining us on the show today. That was Viral Berawala
Thanks.
talking about the factors and his view on the market. We'll take a short break, but before that, also hear out some of the big market voices